Hi friends, I am Roika and I am your mentor for SFM subject. So I hope everyone are doing great. And it's been 10 days since the results are out and congratulations to those who qualified. And I wish you grab good opportunities from the market. And those who did not qualify, just don't get depressed, don't be sad. You're just 6 months away from your CMA qualification. Start your preparation, be consistent. And if you don't know from where to start, just let me know in the comment section, I'll guide you. Now let's start the class, but before starting the class I wanted you to understand what mistakes we do in the examination all and how to approach this subject. These are the comments valuationer has given after correcting June 2025 papers. So the first point they are telling was the candidate should be having broader concept knowledge, and second thing they were telling was most of the candidates have approached the problems without understanding the expectations of the question. So the first 15 minutes you utilize the time for understanding a question. Read it once, twice, sometimes thrice to understand the question, and like which formula we need to use to solve the question. And this is like you have to practice numerous times before going to exam, so it will be easy for you to go to write the exam. We go into 5 most common mistakes that students do. Formula without working. We'll be writing direct final answer, so each and every step should be wrote in a detailed manner, so you'll be awarding good amount of marks. And wrong presentation. For theory questions and all, we'll be writing in paragraph format. Instead of writing it in para format, the points which you're putting in para, just write it in a points way. You'll get better marks than that. And skipping assumptions. And for 1 or 2 questions there will be a need of taking assumption. If you're taking any assumption, you put at the end stating the assumption, what assumption you have taken. And attempting all parts blindly. See, for example, the first question half and second question half. After first question writing half, don't go into the second question. So whatever question you're confident in, first take that question, write the like based on your confidence level you start writing the questions, so it will create good impression. And theory questions ignored. Most of the students will ignore theory questions. You study theory question, you understand the concept, you write it in your own way in the exam and put it in proper format like in points way, then you'll be awarding good amount of marks. And next, what valuationer expects. He'll be expecting working notes. It's like for every working note you mark it, working note number 1, 2, 3, and before that amount you mention this amount is from working note number 1. And for every amount mention units and headings on every table. It is mandatory. For suppose like calculation of covariance, calculation of risk, calculation of return, it's you mention everything. And for every question at the end, after completing the question you write conclusion. So for suppose we have taken fund A, fund B. For fund A we are having Sharpe ratio high, so we are considering Sharpe ratio because we are having high Sharpe ratio. And presentation should be neat. These are the mistakes we will be doing. For next attempt we'll be avoiding you avoid these mistakes and correct those. You'll get good marks. I'm so excited to teach you guys. The first chapter which I'm going to teach was portfolio management. So let's not waste the time and start the class. What is portfolio? It is a collection of investment assets held by an investor. So the investor may invest in 1 or 2 securities. All the securities collectively will be known as portfolio. And these securities may be either equity shares, preference shares, debentures, bonds, mutual funds, government securities, or derivatives. Why portfolio is created? So portfolio will be created just to balance both risk and return. What is portfolio management? It is the process of selecting suitable securities based on risk and return, allocating funds among them, monitoring their performance, and revising investments when required. It is just either selling or buying the shares. The objective of portfolio management. the main objective of the portfolio management is either to minimize the risk or maximize the return. And other objectives are capital appreciation, risk minimization, liquidity, and tax efficiency. It's just a small sentence where you'll be understanding the entire portfolio management. Do not put all your eggs in one basket. If we apply the same in securities also, if one security we are facing loss, if we have invested in other securities, the other security we may get profit from that security. So it's just to balance both risk and return. And what is single security return? The equity shareholder either earns through two components. One is capital appreciation and dividend. In the same way, debenture holder earns either through capital appreciation and interest income. So, what is capital appreciation? It is just the increase of a share value. And dividend income, during the period we may get dividend from the company which we have invested in. Formula: return equals to P1 minus P0 plus D1 by P0. P1 minus P0 is capital appreciation and D1 is dividend income divided by market price at the end of the period. At the beginning of the period. By this formula, we may understand the return from the security. Now, we'll do one small problem. So, Mr. Amit bought 10 shares of TCS on 1/4/2018 for 30,050. The company paid a dividend of rupees 30 per share and the value of stock as on 31st March 2019 was 34,280. Calculate the holding period yield of the investor. So, for example, what current yield? First, we'll calculate current yield. It is okay. Here they have calculated separately both correct yield and current yield and capital appreciation. Directly we can just use this formula. 34,000 P1 equals to 34,280 market price at the end of the period, and P0 market price at the beginning of the period. Dividend equals to 300. How? 310 shares into 30 rupees per share. So 34,280 minus 30,350 plus 300 divided by 30,050. So it is 34,280 minus 350 plus 300 divided by 15.074%. By this we understood the return of single security. So if we have to calculate average return is denoted by X bar. So X bar equals to return of security X1 plus return of security 2 plus return of security 3 divided by 3. It's just a simple average, and when the future data is given, we'll be calculating probability of security 1 into return of security 1 plus probability of security 2 into return of security 2 plus so on. So for this also we'll just check one small formula. A portfolio manager invests in 5 portfolios, namely P, Q, R, S and T in the ratio 30%, 20%, 25%, 15% and 10%. These are probabilities, and the respective returns of the portfolios are 12%, 14%, minus 20%, 10 and 9%. So the return of portfolio will be probability of x1 30 into 3 into 12%, that is 0.12 plus 0.2 into 0.14, 0.25 into minus 0.2 plus 0.15 into 0.10 plus 0.10 into 0.09 equal to 3.8%. Next, we'll go to risk. What is risk? It refers to the variability or uncertainty in the expected return of an investment. It arises when the actual return differs from the expected return. So, in future, there is a possibility that due to some circumstances, either we may get loss or there is a possibility that we may get less return. So, if we calculate that in percentage, that percentage or that rate, we can call it as risk. Technical definition. Risk is the dispersion of possible returns around the expected return. These definitions are not mandatory, just for our concept purpose I am discussing this. Variance. What is variance? It is just a statistical measure of dispersion. If it is having high variance, high volatility, higher the risk. Standard deviation. It is a statistical measure of dispersion which shows the extent to which individual returns deviate from the expected return. Higher standard deviation, higher risk. Lower standard deviation, lower risk. Coefficient of variation. It measures risk per unit of return. For 1% of return, how much risk? This is called as coefficient of variance. It is relative measure of risk useful for comparing securities having different expected returns. Higher coefficient of variance, less desirable. Lower coefficient of variance, return trade-off. So the formula, variance, sigma x square, summation of x minus x bar whole square divided by n. If future data is given, summation of p into x minus x bar whole square. Standard deviation, square root of variance in both the cases. Square root of summation of x minus x bar whole square divided by n. If future data is given, square root of summation p into a minus a bar whole square. Here p is probability. X security. Coefficient of variation. Standard deviation divided by return. In both the cases, either if the data is past data or future data, the formula will be same. Now, next, portfolio return. What is portfolio return? Weighted average of the expected returns of individual securities included in the portfolio. Depends on return of each asset, proportion invested in each asset. This portfolio return, how will calculate? It's a, see, for example, if an investor invested in both security X and security Y, both the returns are in X, he invested 60% of his funds, and in Y 40% of his funds he invested. His returns are 9% and 10%. So how will calculate portfolio return? 9 into 60% plus 10 into 40%. This is 9.4. That is portfolio return. Weight of X, return of X plus weight of Y, return of Y. What is portfolio risk? It is the variability of portfolio return. It depends on risk of individual securities, correlation between securities, weight of each securities. But before going to portfolio risk, we'll discuss one problem. Here, calculate the return of portfolio which has 60% invested in TCS and the rest in RIL. In the sense, 60 in TCS and 40 in RIL. The probable return in different conditions of the economy are as follows. There are three different conditions of the economy: growth, stable and recession. In these three conditions, we have to calculate returns of each security separately and portfolio return combinedly. First, return on TCS shares. The formula to calculate return if the future data is given, then probability of X to X1 plus P2 into X2 plus P3 into X3. In the same way, we will calculate 16 into 0.5 plus 12 into 0.4 plus minus 6 into 0.1. That is 12.2 percentage. The same way risk of RIL share, it is 11.4 percentage. Now risk of portfolio. Formula for risk of portfolio is weighted average of X into return of X plus weighted average of Y into return of Y equal to 0.6 into how much return we got for TCS shares, it is 12.2 into weight of Y into 11.4 percentage, that is 0.6 into 12.2, 7.32 plus 0.4 into 11.4, 4.56, that is equal to 11.88 percentage. Next, we will be going to discuss portfolio risk. What is the formula for portfolio risk? Square root of Wx square sigma x square plus Wy square sigma y square plus 2Wx Wy sigma x sigma y sigma xy. This just from a plus b whole square formula. A square plus b square plus 2ab. So, instead of sigma x in sigma y into sigma xy, we can use covariance of xy. In the future, we will be discussing. There is a formula for covariance. Covariance of x comma y equals to sigma x, sigma y and sigma xy. When more than two securities are given, we will be using this formula. Let's discuss one problem which is from our material. Mr. A wants to invest in two securities X and Y. Security X expected return 12%, standard deviation 8%. Security Y expected return 20%, standard deviation 25%. Correlation between X and Y, they have given 0.15. So calculate the expected return and risk of the following portfolios. If 100% is invested in X, and second option 50% in X and 50% in Y. Third, 25% in X, 75% in Y. Fourth, total 100% in Y. So let's start the problem. What they have given data: security X, security Y, return, risk. Return they have given 12 and 20. 12 and 20, and risk 8%, 25%. So the first one, they have invested entire 100% of their funds in X. So return of the portfolio will be 12, risk will be 8%. Next, second, 50% in X and 50% in Y. Now, what is the formula of return of portfolio? So, return of portfolio equals to weighted average of X, return of X plus WY, return of Y. They have invested 50 in X, so 0.5 into return of X, 12% plus 0.5 into 20%, that is 6 plus 10, 16% risk of portfolio. I have already discussed this formula. When two securities are given, risk of portfolio is, I am writing this formula because you whenever you write it number of times, you'll just remember it. Wx sigma x plus wx square sigma x square plus wy square sigma y square plus 2 wx wy sigma x sigma y sigma xy. So it's square root of 0.5 whole square into sigma x square. It is 8 square plus 0.5 whole square into 25 whole square to 0.5 to 0.5, 8 into 25, and here they have given correlation between X and Y, it is 0.15. So it is sigma xy is 0.15. So we'll calculate this. Into 64, that is 16 plus 156.25 plus 2 into 0.5 into 0.5 into 8 into 25 to 1.5, that is 15 equals to 16 plus 156.25 plus 15 square root, that is 13.68 percentage. Next, third option, 25% in X and 75% in Y. So now return of portfolio will be return of X Wx plus return of Y Wy, that is 0.25 into 12 plus 0.75 into 20. So what is the return? 0.25 into 12, 0.75 into 20, that is 18%. So now risk of portfolio equals to square root of wx square sigma x square plus wy square sigma y square plus 2 wx wy sigma x sigma y sigma xy. So it is square root of 0.25 whole square into risk is 8 plus 0.75 whole square into 25 whole square plus 2 0.25 into 0.75 to 8 into 25 into 0.15. So we'll calculate this. 0.25 into 64, that is 4. $11.25 equal to 19.15%. So in the fourth option they have given 100% the shareholder has invested in Y. So return and risk will be same. Return is equals to 20%, risk equals to 25%. So now we'll prepare a summary based on this in all the 4 options. 1, 2, 3, 4, return, risk. First one, entirely he has invested in X, so it is 12 and 8. 12% and 8%. In second option it is 16 and 13.68%. 16%, 13.68%. And in third option it is 18% and 19.15%. %, 19.15%. So, and in fourth option it is 20%, 25%. Let's just verify this with the answer which is given in workbook. So in the first one it is return is 16%, correct. Next 13 risk, first 13.68, 19.15, 25, that's correct. So next return is 16, 13.68 and 18, 19.15, correct. So this is how we should practice. So let's end this class here. I hope you enjoyed the class and we'll meet again tomorrow. Thank you for watching. Bye bye.